time for our quarterly chat with the top management of Infosys, Mr. S.D. Shibulal, Chief Executive Officer, and along with him Ashok Vimuri, Board Member and Head of Americas, along with Head of Manufacturing Vertical. Gentlemen, good to have you on ET Now. Thank you for joining us. Shubham, I'm afraid whichever way I cut and dissect your Q4 performance, operationally it has disappointed markets. Do you think Q3 was a pop?
So actually Q3 was definitely softer, Q4 was definitely softer than Q3. In Q3, two things came together. Our volume went up by 1.5% and our pricing went up by 1.8%. Both together created a 4.2% growth organically. If you look at Q4, and this is a reflection of the environment which we are operating in, actually the things went in the different direction. Our volume went up by 1.8% and the revenue productivity dropped by 0.7%, and simultaneously we took a cross-currency impact of 0.4%. So this shows how volatile the environment is. The world is volatile and it is going to impact our quarterly numbers. But when I look at overall other factors for the year, I think it's important to look at overall other factors for the year. We started out the year by giving a guidance of 8 to 10%. On a volume basis, our volume has gone up by 8.8% for the year. At the same time, our revenue productivity came down by 3%, which ended us up at 4.5%. So again, the reflection of the volatility. If you look at Q4, there are some good things. We have added 56 new clients. Our $1 million clients have gone up. We have closed about $230 million of large and transformational deals. If you look at the half year, I would think this is one of the biggest for Infosys, about $1 billion of large and transformational deals. Our PPS revenue has gone up to $685 million. So I understand that Q4 has been a soft quarter. While Q3, revenue productivity and volume both came together, in Q4 it went in opposite directions. And some of the deals which we have closed has not ramped up as we have expected. The on-site volume has gone up by 4.7%. Even if I exclude Lodestone, it is something like 3.7%, which means that the deals which we have closed have started on-site operations, whereas the offshore ramp-up has not happened. And that is where we are. But at the broader sense, if you look at it as I was saying before, the environment is volatile. And that is the reality of life. We have a higher dependency on discretionary spend. That is a fact. And that is something which we can't give up, which is something which we need to increase, because that is where we have ability to increase our revenue productivity. If you look at the business and IT operations space, that is where we have we have pricing pressure, whereas in consulting and system integration space, we have higher pricing pressure. So we need to continue to increase that even in this volatile environment. When I look at next year, we have given a guidance of 6 to 10%. It is a broad range because given all the volatility we have seen over the last 8 quarters, we have taken a safer, broader range. A 6% is a 0.5% quarter-on-quarter growth, and a 10% is a quarter-on-quarter growth of 2%. At this point, looking at all the facts which we have, I'm quite confident. I feel confident about the 6 to 10%.
But you struggled in the past with your guidance. Are you confident of this one?
That's why I said we have taken a broader range. We have accounted for most of the volatilities. Our quarter-on-quarter growth required for the lower end is 0.5% and for the higher end it is 2%. Guidance is a statement of fact, right? It is a statement of what we know at this point. And it does assume stable currency and stable revenue productivity. So we have, with all the facts which we have at this point in time, I believe that it's a achievable guidance.
Any reason why you have decided not to give an EPS guidance? Because earlier you gave a quarterly EPS guidance as well as the full year EPS guidance.
So again, it's a reflection of the volatility because the world is volatile, and we are in a stage where we have to invest. We are also in a stage where we are taking cost without higher revenue growth. So for example, last year we gave 6% compensation increase in the mid-year for certain people, and just recently we gave a 3 to 4% compensation increase on site. So if I add both up, there's $140 million of additional cost which we will carry in the coming year. Lodestone, because we are taking a charge, because of the $350 million, only $200 million has been paid out. The remaining money is being charged over a period of 10 to 12 quarters. We are taking a charge of about $9 million per quarter. Lodestone, being a consulting company, it comes with a single-digit margin. Consulting companies operate in single-digit margin. So in the short term, it is negative on the margin. But when the offshore gets built, and we have 5 wins, combined wins in the current quarter. So it is starting to work together. But when the offshore gets built, it will become margin neutral or margin accrual. But it takes time because you have to build 4 times offshore. That's the ratio which you need to build. So that will take some time. So when I look at next year, there are multiple headwinds on our margin. Interestingly enough, you know that we do apply for visas, and we are not sure how much of visas we will get this year because of various factors which are going on, which means that will increase our subcontracting cost. So given all that volatility, we decided that we will give a revenue guidance and stay away from the margin and the EPS guidance.
Talk about some of those headwinds. Ashok, what do you want to start with? Good news first or the bad news first?
Whichever one you pick.
Let's start with the good news, which is the manufacturing vertical. That is growing. The bad news is Americas are not growing.
Well, manufacturing has actually done fairly well. I think it's probably the fastest growing unit now in the double digits, and we've been very lucky in some of the transactions that we have entered into. Has Harley Davidson and BMW are, of course, in the public domain, but we have had a spread of growth as we have restructured the kind of markets and the kind of businesses and defocused on some of the other things that we don't think will give us the returns. So we're very happy that the investments that we have made in our manufacturing and engineering group have yielded the kind of large and transformational deals that we really want to focus and target upon. To your point about the so-called bad news, the Americas market has grown marginally this quarter. It continues to grow in spite of many different challenges. So if you look at the U.S. market specifically, apart from property, apart from housing, and what's happening in the equity market, everything else is extremely fragile. So there is still the overhang of sequester there, which I think has only been delayed and deferred, and I think that ghost is going to come to haunt many companies. I think there is still that surplus money, the stimulus money that's swirling around, which is probably causing the heat in the equities market. But overall, at the corporation level, as Shibu was saying, it is becoming very hard for our clients to take decisions. They are getting delayed, they're getting deferred. If you look at the budgets across sectors, they are typically flat to downish. So if I look at subsector level, there are some sectors which are actually not investing at all. So we've seen U.S. companies go very rapidly global and then pull back as quickly as well. So if I look at the financial services, the capital markets business is actually not doing as well as we thought it should. Insurance is probably one bright spot, but that too, it's a very slow end. It takes a significant amount of time. Our federal government business, which is the Infosys Public Services, actually turned the corner, turned a profit as well. So there are some bets that we have placed in the past which are beginning to yield dividend. And there are certain areas which have traditionally been our strength, which because of the macro environment, because of specific regional situations, are actually taking the brunt. But we're continuing to invest because we think that our clients, if you look at the on-site volume growth, that's a clear indicator that there are a large number of transactions which are in the transition phase, which are in the knowledge management phase, and all of this we hope will actually kick in to drive growth, and that's what we have based our guidance for next year on.
Sure, but many market men are of the view that U.S. economy has revived, that will help Indian IT companies. Are they prejudging the recovery in U.S. economy?
Well, I think, as I said, the data is very volatile. There are some places on which you can hang your hat on and say, okay, I think the economy is rebounding back, and there is again a lot more data which actually suggests that that may not be the case. Is there cash corporations have? Yes. Are they using it? No. Is there a better dividend yield? Possibly. Is that because they don't know what to do with the cash? Is there investment happening in the technology sector? There's huge amounts of volatility. If I look at the chemical industry, now I'll give you an example. We had focused on the mining sector, for example, and that was a big bet, and it was very good for us for a period of time. But with some other parts of the economy, like China, etc., slowing down, that investment and that consumption has actually gone down. So that impacts us because it impacts IT spend, etc. So I would not go out there and make that a definitive call to say that yes, that the U.S. economy is on a rebound. I think there are multiple factors that would make us extremely cautious to make that call.
Shibu, NASSCOM has been industry benchmark. Do you think we should stop comparing Infosys and the NASSCOM guidance?
I think the profile of the corporations, the average cooperation in Infosys is very different. Take a look at it. If you look at the NASSCOM average, their dependency on discretionary is 17 to 18%, whereas our average is 32 to 33%. And the kind of work which we do is very different. So it is not apple to orange comparison. And the dependency on discretionary spend does create volatility for us, but it is important. It is important for the corporation to have that dependency, because that is where we interact with the business of the client, not the IT departments. And that's how you create you strengthen your strategic partnership with your clients. So from a comparison perspective, I think there are differences which one needs to account for.
I know the answer. Before I'm asking the question, you will not react to the market movement. Do you think analysts who track your stock, they should stop tracking Infosys on a quarterly basis? Last time when you came out with your numbers, stock went up. This time the stock has gone down. Do you think that is not the right way to look at Infosys?
As I said, we live in a volatile world. That's the reality. And we have seen that volatility impacting us over the last many quarters. Last quarter was a good example where the revenue productivity went up, the volume went up, whereas this quarter the volume went up, but the revenue productivity went up the other way. There will be short-term volatility, which is the reality of life. Ashok just explained. You were asking about US. I just read a report which said that the PC sales have come down 15%.
Yes.
Right? So the signals are very mixed. So it is important to look at the secular trends, and one quarter do not really define a secular trend.
A famous phrase used by Mr. Narayan Murthy 10 years ago was, there is fog on the windscreen. So is there fog on the windscreen?
There is uncertainty in the environment, there is volatility in the environment. Our clients are struggling to take decisions. Some of the ramp-ups are not happening as we expect, while the pipeline is robust. If you look at the indicators like client additions, we have added 56 new clients. The $1 million clients have gone up to 448. We have wins in the half year. I would believe that this is one of the largest win we had in our history, $1 billion of large and transformational deals. Our on-site volumes have gone up, but at the same time, we have to be cognizant of the fact that it is volatile.
Final question. You are openly using the term margins are under pressure and deal pipeline is or project ramp-up is an issue. Why is that?
No, actually, I think there are two facts. One, on the deal pipeline, I have said that it's robust. And on the win rates, I have said that it's marginally improved, right, the win rates. But the ramp-ups are slower than what we expect sometimes. That's one. On the margin front, I think we are entering the year with a headwind of multiple factors. Number one, because of the compensation increase which we gave, interim compensation increase which we gave, we will take an additional cost of $140 million next year because of the compensation increases were given interim, right? So that will have a $140 million impact. About $36 million will come out of the Lodestone acquisition impact on our P&L. And then, there are other factors which will impact our. So we are entering the year with a cost, cost headwind. Growth is the solution to the problem. Growth will create utilization, and the utilization will, positively impact our margins. But we are conscious of the fact that it is a volatile environment. We have taken a range which is larger than usual. We also, as I said, that the subcontracting costs, the visa utilization for us is going up, which means that we have to recruit locally, we have to our subcontracting cost has gone up from 1.7% to 3.7% over the last few quarters. And if you look at the possibility of getting additional visas, there are some constraints which you can clearly see.
They're visible.
Right. So all of those constraints have to be looked at. That is why we said in the short term, until the growth really picks up, our margins will be under pressure.
Ashok, final question to you now. What could surprise on the upside in this financial year?
Well, I think, just like Q3, if you take Q3 as a microcosm of what could happen, there was a perfect situation where your revenue productivity as well as your volume growth both moved up. You could have that situation. We have many transactions that we have won. In fact, $1.5 billion, more than $1.5 billion in terms of large and transformational deals. So they could all kick in around the same time, and then you could see that resurgence happen. And there is nothing like to get that momentum going to increase the utilization and increase the revenue productivity. The key thing is that we continue to make investments in what we think is important to our clients and important to our business, and we will continue to leverage that to the extent possible. And I think the investments and the bets that we have placed are actually, it's only a matter of time before they yield the dividends even in this volatile world.